Good evening, everyone. My name is Luke Truscott, and on behalf of BOQ Specialist, I'd like to welcome you all to tonight's seminar on purchasing your practice premises through your self-managed super fund. Becoming a practice owner is a major step in the career of many of our clients at BOQ Specialist. It's an attractive option to purchase your practice premises through your self-managed super fund. The rewards can be great, but it is equally important to understand the ins and outs and possible risks. To join me in the discussion with you this evening, I'll be presenting along with three of my industry partners. We'll just go through a couple of housekeeping items first. So if everyone just wants to put their phone on silent, that would be great. Toilets, if anyone needs to go, there's just toilets out there at the front of this reception area here. If you guys want to get a drink, top up for a drink or get some extra food, feel free to go grab a drink throughout the seminar. And also in the bags, you'll find there pad and pen. What we're going to do at the end is have a Q&A session at the end. So what would be best if you use that pad and pen just to be able to write down any questions that you might have. And then at the end, we'll cover those off in the Q&A session. So let's start the evening with our first speaker. I'd like to introduce you to Thomas Kalpak. He's a commercial property advisor from One Group Property Advisory. One Group Property Advisory specialise in the healthcare industry. They provide a bespoke offering to ensure their clients receive the best possible result when making a commercial or residential acquisition through purchase or lease. The advisors are supported by leasing analysts and valuers to ensure the highest level of due diligence and research to guide their clients' decisions. Please welcome Thomas.
Bailed on me, so I'm going to take over. So my name's Tal Eloss. I'm one of the founding directors of One Group Property Advisory, and it's an absolute privilege to be here today. I guess firstly, thank you to Luke and BOQS for putting this event on. Always a privilege to be part of them, and hopefully you take something out of this presentation today. So I'm here to talk to you about the property aspect of, I guess, buying a property through superannuation. So I'll try to make it as relevant as I possibly can to the topic, but we'll also talk through some of the nuances around negotiation with property, and I'll talk you through a couple of case study stories. But I might pick on you a little bit to help me get through the presentation, if that's okay. So typically we see three styles of properties that we typically look for our clients that are looking to establish medical, dental, healthcare style practices. And they're the residentially zoned properties, the conversions, so to speak. There's the retail, ground exposure type of properties, and then there's office space type of properties, which tends to be more popular with specialists and what have you, whereas the retail, typically your GPs, your dentists and what have you, tend to gravitate to those sorts of properties. We are seeing a little bit of a shift. I think as we're seeing a lot of traditional retail in terms of clothing stores and even eateries to an extent move out of retail spaces, we're seeing services really come in. So a lot of the traditional office type tenants in the medical space, being specialists, are now actually gravitating towards retail space as well and exposure. With residential property, probably, without going too much into each of them, but there's probably a very important distinction, particularly here in New South Wales, in terms of the approval process and what's involved in converting a residential property into a medical practice. The terminology within the zoning, and we're very fortunate here in New South Wales that every couple of suburbs is a new council and new rules and regulations and all those sorts of things. But generally speaking, when you're converting a residential property into a medical practice, you effectively converting it into what they call health consulting rooms. When you're converting a commercial property into a medical practice, you're converting it from a zoning definition perspective into a medical centre. Now, it's an important distinction because when you're talking about health consulting rooms, there are a lot of restrictions on that. There are generally restrictions in the amount of car spots that you need, typically 3 per single practitioner that's involved in the practice, which can add up, particularly if you're looking at in the city type of property. And then you've also got a limitation on how many practitioners can actually operate from the premises, generally limited to 3. Whereas under a medical centre definition, you're not usually limited in that capacity. And the other thing also in the medical centre definition is that there are generally concessions when it comes to parking. If you think of a lot of the GP clinics and dental clinics along main strips, there isn't a lot of parking on site for those particular premises. So council is far more flexible in terms of the way that they treat those things. Okay. Any questions there before I move on? Okay. So the pros and cons of buying, and I guess structuring, which is probably the topic of what we're speaking about today, is you're buying a property through superannuation. I won't tell you about all the benefits associated with that. There's probably more knowledgeable people in this room to do that, and they'll be on shortly. But being able to structure it in the way that you want and in the most tax effective manner is definitely one thing. Security and certainty around the location of your site and not being at the mercy of a landlord or a demolition clause or anything along those lines. Investment, so doubles as an investment asset in addition to also serving its purpose for the practice that you're looking to set up and ultimately control around that property, as we do with most real estate when you're comparing it to other assets. Some of the considerations is you're taking on a lot of debt traditionally. You're taking on debt not only for your fit out, which will come in a leasing arrangement as well, but also in the acquisition of the asset itself. And for the most part, most banks will want you to pay not only the interest component of that property, but also the capital repayments associated with it as well. More capital required on startup in comparison to a lease. When you're taking on a lease, generally you're incentivized, whether it's for rent-free or a contribution to fit out or something along those lines. When you're buying a property, you're on your own, right? And you've got to basically fund everything from scratch. And probably business growth strategy. You know, what we try to encourage, I was actually having a conversation with a client yesterday, and they were talking about needing a 100 square metre site to meet their immediate needs, and they were wanting to undertake these strategies in terms of buying within superannuation and what have you. And one of the comments I made is that going to suit you in 5 years' time? Because buying is pretty permanent. I mean, of course, you can sell and buy something bigger, but the cost of refitting out and moving and disruption to business is pretty big, and sometimes it's better to maybe plan a little bit ahead compared to sort of just buying exactly what you need when you sort of work out the costs over the longer term. We generally advise our clients take out about 50% more space than you think you need. I've never, in 15 years of doing this, I've never had a client say to me that we took on too much space. If anything, it's been quite the opposite. So always factor in your growth, because that can be one of the biggest risks associated with purchasing. So where do we find property? So the obvious areas online through realestate.com if you are looking at those residential conversion type properties, realcommercial.com.au if you're looking at more retail, commercial office type of properties. Proactive searching, that's probably a little bit more intensive, where you're sort of hounding the agents and trying to keep front of mind. Generally, they don't take you too seriously. If you look at one property and don't go ahead with it, you're generally blacklisted, and they're not too interested in helping you beyond that. You can look at lease expiry data, which is available through different subscriptions in particular areas, and that's particularly important when you're dealing with, I guess, searching for property in a very specific location where there may be limitations on what's available out there, so to speak. Okay. The other thing is that the other pool of property that's available sometimes for purchase are those properties that are being leased out, particularly those that have been on the market maybe for a significant amount of time. And sometimes, for us, it's definitely a first port of call. Anyone that's looking to lease their property, we'll call the agents up and see whether they're willing to sell, or whether we can lease to buy, so to speak. So explore all the options in there if you are looking to purchase a property. It's really about being proactive. We generally help a lot of our clients because they don't have the time to do this, but if you do have the time to do it, try to exhaust all those avenues. When do I start looking? This is probably one of the most common questions that we get. When do we start looking for a property? If you're looking to buy, I'd say you start 12 to 24 months before, because the acquisition in terms of purchasing is very, very tight. And it's pretty much across the eastern seaboard at the moment. In most of the pretty decent areas, whether you're looking at retail or commercial office space, the market is really, really tightly held. And generally, a lot of the property that comes up for sale are being sold as tenanted investments, which don't necessarily meet your purposes if you're looking to own or occupy the premises. So give yourself time in the process. I'd say if you're buying, 12 to 24 months, depending on the area that you're looking at. If you're looking at leasing, 6 to 12 months before you occupy the premises. If you're looking at relocating, you generally want to have a 6-month crossover with your business in terms of holding both sites so that there is a smooth transition for your patient base as well. Okay. What sort of things do you look at when you are, I guess, assessing a property and its viability for what you want to do? I mentioned with the residential conversions, there's a lot of work that goes into those to determine whether they are suitable for approvals to convert into a medical centre or into a health consulting room, as I mentioned before. Generally, when you're looking at residential conversions, you're looking at a DA process. So that means that it's going to go through council. It's going to be a 9 to 12 month approval process. Add to that your 3-month to probably 4-month design and your collation of documentation, and then you fit out on the end of that. At best, you're probably going to be in the site within 18 months.
What if it's already operating as what I want?
Yeah, it's a very good question. So if it's already operating as a medical practice, first thing is check that there were approvals in place. What we're finding is not only in residential property, but also in commercial property, a lot of the historical properties never actually had approvals. And if you don't have an approval and you go in there, you run the risk of basically council turfing you out. But generally speaking, if they've gone down the right path and they've got their approvals in place, as long as there's been no disruption in the tenure of the property, i.e. that it wasn't a medical centre and then became a hairdressing salon for a little while and then you're going in, as long as it's a continuous use, then generally it'll be grandfathered through. Okay. Some of the other things you need to look at, permitted use. So if you can generally do that quite easily through a council LEP, and you go into the zone that the property sits in, and you can have a look at what all the permitted uses are associated with that particular zone. Okay. And some of the other things that are very business specific around what you can and can't do. Don't always assume, though, that just because it sits in a certain zone that a property is automatically approved, say, for a medical centre. We had an instance in the northwest of Sydney, around Bella Vista, if everyone's sort of familiar with that area, with a particular complex where there were a couple of properties within the same complex for sale at the same time. And we explored both of those properties. One was a gym previously, and the other one was just an office space. When we conducted our town planning research and our certification research, we were told that the property that was operating as a gym would need to go through a full DA approval to be turned into a medical centre, whereas the one in the same complex, same address, and literally a stone's throw away, that was an office, would be able to go through a CDC or a complying development process. So within the same building, same premises, same address, same zoning, one property will take 18 months to get approved and the other will take 2 to 3 weeks. Okay, so be very careful. Make sure that you seek your town planning advice. Make sure that you try to get a letter of concurrence from a certifier that basically says that they will sign off on a particular property that you're looking at. Be nothing worse, and I always say the most expensive mistake that you can make in property is really just buying the wrong one, right? Because it's very hard to undo. Yeah. With regards to pricing assessment, again, you can try to do your own homework. It's a little bit more difficult with commercial property. Not, the sold prices and things like that aren't as readily available as what you'd see in the residential space. But definitely you can find some information. You can speak to agents that are perhaps not listing the property and try to get their opinions as well. Okay, so I'm going to tell you some stories. So these are sort of case studies for me and some learnings that have come out of them. And the first one is the agent is not your friend. Okay, and this probably applies not only to commercial property for your practice premises, but probably is probably associated with any kind of property that you're looking to purchase. Firstly, no one needs to know what you do, right? If they're showing interest, it does not work in your favour to tell someone that you're looking to buy a property from or the agent that's representing them that you are a doctor. If anything, it'll probably work against you. Okay. The second thing is, don't give information freely. You want to be the one asking the questions, not receiving the questions and then fulfilling with the answers on the back of that as well. Okay.
Why would work against you?
Well, generally, you tell them you're a doctor and they see dollar signs. Yeah. That's the basic gist of it. Yeah. And, you should approach anything that you're looking at, whether it's a home or whether it's a, commercial property or whatever else it may be, approach it under the guise of you're looking at it as an investment, because then you're taking away the emotional triggers associated with the site itself.
And you're referring to the selling agent or the buying agent?
Yeah, it's a good question. Yeah, so we're buyer's agents. We act for the buyer. So of course, if you're working with a buyer's agent, you want to tell them everything because it's important. They know where they stand, and they're obviously representing you. So it's a very good question. But no, we're talking about the vendor's agents, because has anyone bought a property in the last 5 years, say, for example? Yeah. Typically, when you go into a home open, you start getting peppered with questions, and again, they seem fairly innocent, but they're all designed to get an understanding of what your budget is, what your circumstances are, what you do for a living, and how likely they are to be able to push you into purchasing the property. Okay, and that's when the games sort of start from there. Whereas if you take away those emotional drivers, it's going to put you in better stead. Okay. The story I want to tell you here to demonstrate this point was actually relating to one of our clients who was a vet. We ended up finding a property for him. This was a lease. It wasn't a purchase, but the point is the same. We attended an inspection of an off-market property that we'd found. It was literally 2 doors away from a current premises that he was subleasing from. And went into the inspection, and it turns out that our client happened to have some commonality with the agent. They knew some similar people. He was a chatty fellow, and they found out very quickly that they knew some common people. So, of course, he ignored all our advice, and he started opening up. This is the perfect site. Let's do a deal, and it was all good and rosy. And we're sitting in the background with our heads in our hands, and the agent, as he walked away, said, "I'll come back to you with a price." And normally that's not an issue, but he'd already given us a price. Right. The client turned to Thomas and he said to him, "I think we did a good thing." I said, "No, we didn't." And he said, "We did a good thing. You'll see." So the agent who had given us a price of $180,000 came back to us a few days later with this is per annum, came back to us with a price of $240,000 per annum. Right. We were able to negotiate that back down to about $200,000. But the point being is that we started the negotiation from $240 instead of starting the negotiation from $180. Okay. So I always say, when you go in to inspect a property, pretend that you're smelling something bad, and that's the look that I want on your face when you enter the property and the whole time you're in there. So just be very careful, because your medical professionals are generally very trusting. So you don't want that to be used against you, and it will be if you allow it to in these circumstances. Any questions there? No? Okay, second point, and I alluded to this in the previous point, is ask questions. Right. I've said to you, it's bad for you to be answering all the questions, but it's definitely good for you to be asking the questions. Okay, because that'll give you an idea of what the drivers are for that particular vendor. And the story I'll tell you here is for a dentist that we were looking at a site for down in the Sutherland Shire in Sydney. And the client had gone to the inspection and spoken to the agent. The agent gave him a price and he said, "I'll take it." All right, no negotiation or anything. Now what happened is his finance took a little while and it was dragging out, and it was about 2 months since the client was referred through to us. I had a chat with him. I said, when's the last time you spoke to them? And we took over the negotiation. So I went there to inspect this particular property, and I spoke with the agent. I said, what's the story with this property? It's been around for a little while. What's the hold up? What's been the hiccup? He said it was actually under offer from a developer, and the developer had a due diligence period on it. It failed the due diligence, and they decided not to take up the property and exit on the cooling off. Or in commercial property, there are no cooling offs. It's a due diligence period that you negotiate. And the first thing I turned around and said to him was that, well, you know, we're not a developer. We don't have developer money. And he said, no, of course not. So automatically I know I've talked him down from where that particular developer had offered, which coincided with the price that my client had agreed to. Okay. Now, in that particular instance, they didn't know that I was representing this client. We're going to find out eventually, but we wanted to negotiate everything first. So he kept talking, and this particular property was a funeral home. And it had a chapel inside, and it was, you know, fairly modern. And he said one of the other issues that we've got is that the current owner runs a chain of these particular funeral homes. And they don't want an investor to buy the property because they don't want an investor to then go and rent it out to another funeral home, because the fit out is worth a significant amount, and whoever bought the place, if they did want to rent it out to another funeral home, would probably get a significant amount of money. Okay, so I made comment to him that, look, we could probably get around that, and we'd probably be happy to have a legal undertaking that we would not set up or rent out to another funeral home. But of course we'd have to be compensated for that. Again, just planting a couple of seeds. We ended up saving about $200,000 on that site. So it was from 2.2 million to just over 2 million. So it was slightly under $200,000. Again, that was all on the back of questions, right? Understanding what the motivations were, understanding the history, understanding, you know, how quickly the person wants to move, what their concerns are, and then structuring a deal that is going to appease those things and get you a better result financially or from a term perspective or whatever else it may be. Okay. A lot of practices that we help set up or require the properties for these days tend to be in strata buildings, whether they're office space or retail space. Purchasing freehold buildings is getting extremely expensive these days, and is not usually a viable option. So there's some really important things that you need to inquire on when you are looking at strata premises, and whether it's to buy or whether it's to lease. Okay. Firstly, speak to the strata manager. You need to get an understanding of what you can and can't do on site, and whether they even want you in there at all or not. You'll be surprised with the amount of buildings that don't want medical in them. So do not rely on the advice of the agent. Speak to the strata manager themselves. Okay. Core holes, does everyone know what they are? Sort of drilling sort of round holes into the slab to allow for your plumbing and those sorts of things. Ask about what the procedure is involved in getting those through. Okay, so that you can get an understanding whether it's even an option or not. Does it have to go through a special bylaw? Does the committee just sign off on it? What is the process involved in touching the slab, as we call it? If you're on the ground floor, it may be dredging. If you're on an upper floor, it may be core hole drilling through. Okay. Is there a special bylaw that's required? And again, the methodology around the approval. I'll give you an instance, and this is point 2, speak to an impacted tenancy. So if you are drilling through a particular slab, generally there's someone underneath you, right? So you could go through the strata committee, you could get all your approvals, it can pass. Generally there'll be one person objecting. Who do you think that would be? Person's right underneath you, right? Because they don't want necessarily plumbing going through there, or if you're putting a toilet in, that they're going to have sewage running through their roof. It's, they view it as a risk. So you can have all the approvals in the world, it doesn't give you access to that premises. So before you submit anything like that, if you are looking to drill through the floor for plumbing or otherwise. Now, there are alternate methods such as pumping water and all those sorts of things. They're not ideal, but you can make them work. But if you are looking at doing anything like that, just a courtesy, go down, have a chat to them, see what their concerns are and how you may be able to alleviate them. Because if the first time they hear about it is at an EGM for the body corporate, guarantee you they're going to object. And it's not going to stop you from getting the resolution through, but it will stop you from getting access to their property. Okay. Again, also check if you're using any sorts of equipment, check the electricity loads, the plumbing, all those sorts of things that are associated with the building as well. Okay. So I'll finish off some of the tips that I have, and I guess summarising some of the things that we've spoken about is, maintain confidentiality. What I mean by that is that, keep your information to yourself. No one needs to know what you do. No one needs to know what your budget is. No one needs to know the purpose of the particular property. It's very different from leasing. If you're going to lease a property, you can use your profession to your benefit because you're a strong tenant to have. But when you're buying, that plays no part whatsoever. Okay. Always have a plan B even when you don't. So if you're going into a particular property that you like, and again, this is probably links in with number one, the agent doesn't need to know that you're looking in one particular location or two particular suburbs, right? You can be open to buying absolutely anywhere in Sydney or anywhere on the north side, and you're always looking at a few options at a time, right? So don't ever let them know that this is the option that you've honed in on and this is sort of what you want. Research the market, make sure you understand what the square metre rates are. And look, one thing about agents is they are fairly chatty, and when you get a hold of them, they are fairly willing to give information to you if you ask the right questions around what the stock levels are, what the rates per square metre are, and focus on the key agents of the area in the area that you're looking at. They're not hard to find because generally you'll see, particularly in the commercial space, they'll be fairly entrenched in a particular suburb. Okay. Know your requirements around size and location and be very defined in what you're looking for. That's going to make your life a lot easier. And fifth, and probably most importantly, probably ties into the due diligence aspect, which I'd probably include in number 5 as well, is get town planning advice, get certification advice. Don't take it as a given, not from a fit out company, not from a real estate agent. Own your own advice. Pay a town planner, pay a certifier to give you that advice, own that advice, and then you can take it to any fit out company you like or whoever else it may be. That's pretty much me. Have a go on time, hopefully not too bad, but yeah, thanks for putting up with me for the last half an hour or so.
Thanks, Tal. One of my colleagues actually had a client who went and bought a property without getting any due diligence done, and then it went to council and they couldn't even get the approval to be able to have it as a practice. So
yeah, we had a client did the same thing and ended up having to build duplexes on the site just to break even. Yeah.
So yeah, got to be very careful. Thanks very much, Tal.
Thank you.
Our next speaker this evening is Alison Lacey. Alison Lacey is a director with Ecovis Clark Jacobs, and she specialises in advice to medical and dental clients. Alison has over 25 years on practice. Alison has a very good understanding of the practice and personal financial issues her clients face. She works closely with clients to set up systems and manage cash flow for future growth and wealth building, with a particular interest in superannuation and financial planning. Our topic tonight is, of course, one of her favourites. Please welcome Alison. Thank you.
Hi, so we'll jump into it. So history of borrowing and super. So borrowing in your super fund's been around for quite a long time, back to pre-97 days it really came in. It started around having geared unit trusts. There was a lot of structures in the past that people used to use, and the ATO really tightened, cracked down on things, eliminated borrowing there was no borrowing in super, But they then started to introduce other arrangements, particularly around the big investment banks, brought in some of the warrant investments. Probably the most well-known one would be the Telstra 2, T2 warrants that came in. After that, the ATO and ASIC looked at it and said that we will allow borrowing in super from September 2007, and it became interesting but not very popular back in those days for self-managed super funds to look at borrowing to buy property. It became progressively more popular as the banks started to introduce borrowing arrangements. And there was limited recourse borrowing arrangements, which means that the bank can only ever access the property itself. They can't access the actual funds in your super fund. They can only ever access, they have a limited amount of recourse against the loan for the property itself that you're using to borrow. It's not common, so it's still quite unusual, I guess, in terms of overall market types of borrowing, and a lot of banks don't do it anymore. There was a period where lots of banks were starting to do it, and then over time ASIC and the ATO have tightened, the rules around self-managed borrowing, and it's still what would consider an exotic product kind of thing. It's not what you would see in the market typically. It's not what is rolled out as a general banking product. The big four banks, your NABs, CBAs, ANZ, Westpac, really don't do self-managed super fund lending anymore. It's down to more specialised lenders like BOQ Specialist and some other people to find the products that will enable your self-managed super fund to borrow to buy property. The Labor government doesn't like it. It's considered, and we'll have a look at some headlines in a minute, it is considered, I guess, an arrangement that lets a small group of people, those with self-managed super funds, borrow to buy property that's not just generally available across the whole market for people to have in their superannuation funds. So we don't know what will happen in the future. There's been commentary around will that be changed? Will they get rid of borrowing in super funds in the future? But certainly at the moment, it's fine. We see a lot of headlines in the media all the time. And these are just some of the ones from sort of the last 12 months. In fact, really this financial year that we see in the media. There's not a lot of understanding around how self-managed super fund borrowing works. So you get a lot of emotive headlines around it. So you can say, different quite well-known brokers, Financial Review, different home loan experts, etc., have quite emotive headlines around it. We think it's going to continue. We don't think there's anything that's going to really stop it in the short term. It is impacted heavily by changes in interest rates, because as interest rates go up, and I'll show you in the next couple of slides how borrowing in self-managed super fund is a more expensive exercise than compared to normal investments. But it is becoming more popular, I guess, as the number of self-managed super funds grow, and people are looking to potentially take their super out of more managed investments and control it themselves. So because we're accountants, we'll do some numbers. So this slide is designed to highlight what self-managed super fund borrowing looks like, or buying a property looks like inside super and outside super. We've got some very general numbers, and obviously this is not advice. This is very general to sort of demonstrate the different outcomes that will happen because of different legislation and because of different tax rates for self-managed super funds. So if you were looking at buying $1 million property outside super, you've got normal purchase price, whether you're inside or outside, whether it's a super fund buying or not. You've got your normal stamp duty, your normal legals, etc. Where you start to come up with some differences though are around these LVRs, which is the amount of money you can borrow, and interest rates. So you can see apples and apples, if you like, in this slide. We've kept it at 90% LVR, so you're borrowing 90% of the purchase price. Interest rates, though, for self-managed super fund borrowing are definitely higher. We've used some BOQ numbers from Luke to demonstrate this example. So if you were just a general investor borrowing to buy this property, you'd probably pay 6% with a 90% LVR. If you're a super fund, you'd be paying 7%. So there's a higher interest rate to start with. There's also higher costs. If you have a look at the legals conveyancing line, it's more than double, and I think that's quite reasonable. We definitely see the cost of buying the property from a legal perspective and the borrowing costs with the banks as significantly higher than if you were an individual buying in your own name. And that's because when you use a self-managed super fund, you have this limited recourse borrowing scenario. So the banks want to look at all of the documentation in detail around your super fund deed, around the limited recourse borrowing agreements for the super fund, and they get their lawyers, like you go to your lawyers or your advisors to have those documents drawn up. Those documents that all get sent over to the bank's lawyers to have a good read through and make sure they're all quite happy. We've had instances where clients have had those documents sent back by the bank. Please change these things because we're not happy with them. So quite a bit more expensive, and more expensive for interest rates. So now moving down to our borrowing line, apples and apples, as I said, we're borrowing $900,000 for each of them. But because our costs are higher, you've got to put a bit more money in if you're borrowing with a super fund. You're probably going to get 4% yield. This is an example, obviously. Rental yield, interest on loans higher for the super fund because the interest rate's higher. Rates, insurances, other costs the same. So our total costs are higher for super fund borrowing, which means that you're more out of pocket if you're a super fund and you're borrowing. And now we get to the tax line. So down here, our tax reduction amount. So we're assuming that if you're, medical, dental, possibly on the top tax bracket if you're borrowing yourself. So our tax reduction is at 47%, the top tax bracket. But for super funds, it's only 15%. Super funds only get a tax deduction of 15%. So quite a different result in your after-tax cash flow of what it's costing you to hold that property.
Is LV 65%?
We're looking at apples. I'm doing this slide so you can compare apples and apples at this stage. Luke, I understand BOQ will, though, potentially do 90% for practice borrowing for a super fund.
Yeah, we do.
Yeah.
So, that's the maximum.
So potentially, yes, you can do it. Not a lot of lenders do it. In fact, hardly anyone does it apart from BOQ. So we're now looking at our next slide, which, sorry, I'll just go back. So this is what it's costing the super fund or the individual, whichever one you're looking at, year on year to hold that property. So quite a bit more for a super fund to hold it. In our next slide, we're looking at what are the repayment terms for a super fund. So if you are an individual buying the property in your own name or a company or a trust, it's quite likely that the banks will lend you the money on a 25-year term. So you've got 25 years to repay that principal. So our $900,000 that we borrowed originally, 25 years as an individual trust company, I'm paying $36,000 back a year. As a super fund, though, because it's a much more regulated product and the ATO and the government do not want you to have, super fund borrowing for a very long time, and because it's a non-recourse loan, the banks want their money back faster. So much more regulated, less security for the banks. They want their dollars back. So typically super funds will only lend 15 years, which means that your principal repayments are significantly higher. So you've got to factor that into your holding cash flow. Our cash flow holding costs, I'll just go back a slide. We had 11 and 25. If I add that to my principal reduction, because super fund loans are always principal and interest, you've got a very different number in terms of what you've got to cash flow within your super fund to hold that property. And in fact, if you're factoring in that this shortfall needs to be met by super contributions or other income to fund that holding cost, you'd have to have $100,000 to fund that property. And given we can only put in $27,500 per member per year, that's pretty high and unlikely to happen. What I've done in our next slide is basically the same numbers, $1 million purchase price, but we've looked at it in a quite different way in terms of our LVR. So an individual company trust might still put in 90%. You know, you can certainly borrow 90%, no problems. But what we see typically with our clients is that they don't borrow 90% because the holding costs are just not affordable in terms of long-term cash flowing this property within super. Typically what they're borrowing is around 50%, 60%, that sort of thing. So I've done these numbers on a 50% LVR, which means you're putting in a much bigger deposit. So in our individual company trust outside super example, we're going to borrow $900,000 against this property. But in our super fund example, we're only going to borrow $500,000, which means you've got to come up with $552,000, $553,000 to buy this property in your super fund. So that means you've got to come up with it from assets that are already in a super environment. Typically, to set up a self-managed super fund, you're going to roll super over from other funds that you already have. Obviously, you can have more than one person in a self-managed super fund. You can have up to 6 people now in a self-managed super fund that can all invest together. Typically, though, we see that as family members. It's not common, unless you're in a business relationship with other people, to have a self-managed super fund with multiple unrelated people. But we do have it. I've got clients where 3 or 4 people have set up a self-managed super fund to buy their business premises, and they're not related, obviously. They're all practitioners. They've rolled money into that self-managed fund, and then the fund has bought the property. So there's ways and means to kind of come up with it, but you are looking at a bigger initial cash requirement within your self-managed fund to do it. The numbers are pretty much the same, certainly for the outside super numbers. We're still coming down to that $11,000 holding cost. But obviously, because we've put a much bigger deposit into the property, our interest bill is significantly lower and we actually end up cash flow positive. So if the super fund ends up cash flow positive, looking at our similar kind of numbers from before, we only borrowed $500,000, not $900,000, so significantly less in terms of principal repayments. Holding costs much more affordable, and hence, you know, post super fund contributions, again, much more affordable in terms of being able to hold the property. Any questions on the numbers while we're looking at these? Okay. So that's affording the property, like that's how we hold it, what it costs us to hold it, and how the numbers look. This one is looking more at when we sell the property or down the track. So it's designed. This slide is kind of designed to show you what happens if we owned it outside super, so in your own name, company or trust, inside super but you haven't retired yet, or inside super but you have retired. So our numbers are pretty much the same. We've kept, you know, apples and apples. We're selling it for 1.5, maybe in 10 years' time. Our capital gains numbers are different, obviously, because super funds had more upfront costs, but apart from that, pretty similar. What happens though next is quite different though in terms of how the capital gain is taxed, because if you're an individual company, no, not company, but individual or trusts, you get what's called the capital gains 12-month discount. So when you've owned an asset for more than 12 months, only half of that asset is taxed. So you get a discount of 50% of the capital gains. Super funds get a discount of 15%. Sorry. Let me mental blank.
They did discount 1/3.
1/3. Sorry, yeah, 1/3. Not 15%. 15% is their tax rate. So less capital gain discount. If you're an individual and it's been your active asset, we're assuming you're buying practice premises here, You could also access the small business capital gains discount, which is another 25% discount. Super funds don't get that. And that leaves you with an assessable taxable gain of 113. You pay tax at normal rates on that. However, if you're nearing retirement, you could roll that amount of money into super, or if you're at retirement age, you don't need to, and you'd pay no tax on that gain. But you've got to jump through all those hoops to get there. And you've got to be selling it really when you're getting towards that retirement age. Otherwise, you have to put quite a big chunk into super to get that no tax scenario. If you sell it, and if you own it in a self-managed super fund and you haven't retired when you sell it, looking at column 2, we still get the capital gains discount. You still make a capital gain in the super fund, and then you are paying tax on that capital gain. So it's costing you $44,000. Super funds pay tax at 10% on their capital gains. So it's a discounted tax rate, but still taxable. The big kicker though is if you sell it, self-managed super funds sells when you're retired, in which case self-managed super funds, as long as you're below the asset cap of 1.7 million, which is the pension cap, not asset cap, pension cap, self-managed super funds then pay no tax on their capital gains. So no tax at all. You don't need to meet any of the small business concessions. It doesn't have to be an active asset. It's just tax-free when you sell it. So that's a significant result. Whereas compared to here, you still need to be working and it still needs to be an active asset in order to access those small business concessions. Questions? Lots of technical terms I know, and lots of, comparing black and white.
I would like to believe that this scenario of having assets below the threshold of 1.5 would not be a common outcome for specialists, and therefore this option that you mentioned that could be particularly beneficial probably wouldn't be applicable down the track.
To be honest, a lot of my clients do not have significant assets in super. They might have assets outside super and things like that. It can be a strategy that you look at and target. If you sell it and you've still got debt on it, it depends on timing and things like that. But certainly that is an outcome that is likely for quite a few people.
Alison, can I ask a question? If I buy a property in super for $1 million and sell it in 20 years' time for $4 million, and I own it in my own name, how can I get $4 million into super in 20 years' time?
You can't.
How can I get $4 million into super like this scenario?
You can't, because...
But I can if I buy it in the super fund.
If it's bought in the super fund, you get the growth of that asset in super, and even though you might not get a zero tax rate, you're still going to get a much more concessionally 10% tax rate versus 47. Mm-hmm. If you sold that, in 20 or something years' time and you're not in business, you certainly won't get this concession or this concession, and you're going to get taxed on 50% of that gain. So whichever way you look at it, if it's owned by a super fund and you're comparing just a 50% discount compared to significant discounts over there and a potential for, if you sell it for $4 million, you're going to be in the top tax rate when you sell it, 47% tax rate versus 10% tax rate. Very significant difference still in super versus outside super.
Yeah, still it's
Yep.
Alison, is that because of that 1.7 cap? Is it? So
yes. So you only get
million,
if you sell it for $4 million, if you were
super.
structuring your super, 1.7 would be in pension mode and the rest would still be in accumulation. So you'd have to pay tax on part of more than half of the gain, but you're still paying it at 10%, not 47%.
Yeah.
The other thing, Alison, as well, and I guess in addition to what Heath was saying, is that once the property's actually paid off, you continue to bolster the
fund.
Super fund balance through rent, right?
Yep. Yeah, so the rent goes in, and the rent's then concessionally taxed 15, not whatever your marginal tax rate is. Yeah. But going back to Heath's point, the big part of it is getting money into super. So you can put in $27,500 and get a tax deduction at the moment, $110 not tax deductible, but personal contributions. That's it. Whereas if you've got an asset that grows from the $1 million over many years into 2 million or 3 million, you're getting that asset growth in super without needing to physically put the dollars in. Yeah.
Just to clarify, the 1.7 is assets within super, not your own personal assets, correct?
Correct. Yeah, it's the balance of your super fund. Yeah.
Per member.
Yes.
So it's husband and it's spouse and spouse. Each spouse gets 1.7.
7.
So you can have 3.4.
What happens when you grow old and die? Does the super then, can it go to your kids?
Yes. Yeah. That's an estate planning conversation, but yes, you can leave those assets to your estate and distribute them that way. Yep. You had a question?
The question.
Oh, okay.
Per person.
Yep, per person. Okay, so clock is ticking. So it goes back to what Heath's comment was. It's about getting money into super, and the more we love super funds. Like, you know, I have a super fund. Heath's got a self-managed fund. Whether it's self-managed or not self-managed really is not necessarily a key issue unless you're looking at buying property. But the clock is ticking thing is around how much can I get into super? And the reason we love super in general is because it's the most concessionally taxed structure. What investment you put in your super fund is up to you. You know, you can have a managed super fund and you can have a conservative, balanced growth, high growth kind of portfolio someone else manages, or you can have a self-managed fund that you manage the investments of. But it's getting the money in. And because we have these caps that you can only put certain amounts in, the sooner you get it in, the better, and the better you get that compound growth for the long term. So if you can borrow to buy an asset in super, you get the leveraged aspect of that growth as well as just your dollars that you can put in year on year. You're getting a bigger pool of assets growing faster for you. Oh my goodness, sorry, that's my alarm. Will borrowing always be allowed in super? That goes back to that comment, sorry everybody, that goes back to that comment around, sorry, children's tablets alarm. That goes back to that conversation we had with those news and media headlines. Will Labor change it? I don't think so in the short term. In the long term, maybe. Don't know.
If they change it, would they be retrospective?
I doubt it. I think it'd be I think it would be grandfathered, and the borrowings that are in super would stay. They'll just cut it out going forward. They have over time tightened it up. So when self-managed super fund borrowing initially happened, I could lend money to my super fund on relatively, I would hesitate to say, but loose terms. That got tightened up a few years ago, and now it's got to be on ATO terms or bank terms. And they really do not want that scenario to happen. They want you to be borrowing from third-party lenders, so it's all official and above board. Consequences of transferring property into super at a later date. Apart from the timing factor, you know, if you've bought the property in your own name and it's your practice premises now, if you transfer it in now, potentially you've got a capital gain. If you wait 10 years, you're going to have a much bigger capital gain that's going to get taxed in your name versus get taxed in the super fund. So it's a cash flow question sometimes too. If you've already got property and you want to put it in super, it's a cash flow trade-off question. Will I wear the tax burden now of that gain that I've already made and transfer costs and things like that? Or will I do it later? Will it incur stamp duty? If you own it in your own name, this is a potential scenario. Own it in your own name. It is your practice premises at the moment, and you want to put it into your super fund. There are stamp duty concessions which really reduce the amount of stamp duty to very minimal, hundreds of dollars instead of tens of thousands of dollars. But there are restrictions around whose name that property goes into the super fund. And so if Alison owns it, Alison as a super fund member needs to then own it. So it's a discussion to have with your advisors. Other taxed imposts to be incurred, well, that's that capital gains transaction that we talked about. If you transfer it from your name to your super fund, it is triggering a capital gains tax transaction. Effectively, you're selling it if you like, even though you might put the property in specie, but you have tax consequences in your own name. Is it right for you? Depends. Again, it's individual circumstances. How old you are, Obviously, if you can afford to do it at a younger date, you've got a longer time frame to pay things off for. If you're doing it at a later date, you need to think about, can the super fund cash flow the repayments and the loan, carry the loan, etc. How much have you got in super? So we saw in our two examples, in one example we borrowed 90%, another example we borrowed 50%. Very big after-tax cash flow holding costs is going to be impacted. So if you don't have a lot of money in super at the moment, it might be difficult. If you do have a substantial balance in super, you might have other assets and liquid assets, etc., that you can afford to cash flow it. Investment return on paying off a non-deductible home loan versus putting money in super. So that's a question we do with our clients all the time. I personally think it's a good idea to get your foot in the door and have a home loan under control. But if you're looking at a very long-term scenario, I think it's also equally important to be putting money in super all the way through. One of the biggest discussions I have with my clients when they're in practice for themselves is that if you went and worked for a boss, you'd be getting 10.5% super on your earnings going into super every year, because that's what employers have to do for their employees. And so in 20 years' time or 30 years' time, when they retire, they've got a very substantial nest egg in super. If as a self-employed person, you don't ever have a requirement to put money in super, and you don't, you'll have nothing in super come the end. Because of those restrictive amounts that you can put in year on year, very hard to get it in at the end. And likely differential. Yeah, we think, putting it into super is going to give you a better, more than 50% better chance of having a good super balance come the end. A lot of you are kind of, I think, younger in this room. So I thought I'd give you, oh, sorry, Tal. See, they haven't had their tablets. This gives you an idea about what's happening with self-managed super funds, and they are becoming more popular. We had a lot of funds get set up a few years ago after we had a global financial crisis scenario. And then because people kind of go, I want to control my own money. I've had terrible results in super. Let's do it ourselves. We then kind of taper off a bit, and we hit COVID, and again, terrible financial results for a little while. And again, lots more people setting up super funds. But equally, lots of super funds get wound up. It's not for everyone. Setting up a self-managed super fund is another set of accounts and tax returns to do. And for your investment money, you now have to manage it. So you might manage it yourself, and if you're great with shares or with property or with other types of investment. But I'm not. I'm a great accountant, but I am not the best, financial advisor. I don't know. I'm not a stockbroker. I don't pick stocks. So, I was reasonably happy to let my super fund tick over in a managed environment without me having to be the investment manager and without me having to do another set of accounts and tax returns. The only reason I set up a self-managed super fund was because I wanted to buy direct property in that fund, and that's the only way you can do it. There are a lot of people, there's 1 million people in Australia with their money in self-managed. So it is quite a big structured environment, very regulated. I mean, these are ATO stats. It's very regulated. The ATO cracks down on it. If you do the wrong thing, there's big penalties. So if you're going to look at doing self-managed super, you need to be quite aware of what's involved and go into that setting up the structure with your eyes open. Accessing super. So it's all great to talk about, let's put the money in, let's buy investments and let's do things, but how do we get it back out again? So you can access money through your self-managed super, the same as managed super, when you turn 65. Whether you've retired or not, you can access your super at age 65. You can access it when you reach preservation age and you retire. We'll talk of this as preservation age. Or you can access it under transition to retirement pension rules while you continue to work. So preservation age, because they want us all to work a bit longer and not access our super early, depending on your date of birth, these are the ages that we reach preservation. So for most people, it's moving towards that 60 years. If you hit 60, in order to access all of your super entitlements, you need to have a retirement event. So you've got to retire from a job with the intention of not going back to work. If you do want to continue to work, but you're at 60, you can access it under transition to retirement rules and start to access some of your pension, but not all of your, some of your super, but not all of your super, which you can do once you hit retirement or 65. And then how much do you actually get? So when you start a full super pension, which they call an account-based pension, again, depending on your age, it will determine how much you can access. So if we have a look at, really, we're looking at the numbers in 22 to 23 is where we're at, the last column. But I actually think it might revert back to the previous column. So sorry, this is where we are this year. This is what it might revert back to, because that's what it used to be. At the moment, we have these, if you like, discounted rates. So if I'm under 65, I can withdraw a minimum of 2%. There is no maximum for all of these age groups. You can take your whole super out if you want to, no maximum. If I'm 65 to 74, I've got to draw a minimum 2.5% of the balance of my super fund as my minimum pension. The reason I say it might revert is when we had GFC, then when we had COVID, they brought in these discounted amounts so that people didn't have to access all their super if they didn't need the income. And they've pretty much never put it back, but they might. And the reason they might is because as our population ages, they very well might politically want people to take their super rather than rely on the age pension. So I think it's likely that at some point down the track, our reduced amounts, which is where we are, will end up being these higher amounts. This is kind of important when you think about the mix you have in super and what your super fund generates in terms of income. So if I've got a super fund and it's producing income from its assets of 5, 6, 7%, great. I'm fine at these early ages because my super fund is producing more income than I need to take as my minimum pension. What happens though if I've bought this property in super, which is only producing 4% income? Well, let's assume that's our only asset. I'm earning 4% income on my investment asset. And now I've got to draw 4.5%, 5%, 7% as my minimum pension. So if your only asset in super is that property, I can't sell the front door. I'm going to have to sell that asset to give me cash to pay my minimum pension. So buying one asset in super as a property is okay as long as it's part of a managed strategy. But buying one asset in super and thinking that's it and just paying it off and not having other liquid assets is going to be a long-term problem for your self-managed super fund. When you get into these higher age groups, you're going to have to sell it to produce the cash to pay out some pension, to pay minimum pensions. So super's not a set and forget scenario, particularly if you buy property in a self-managed super fund, but it can be very good. It can be a great investment structure to own property in for the long term. Rent and buy, I think Tal covered a fair bit of that. We quite like it as a rule, and I have to say, as accountants, we've just bought our practice premises, so we're practicing what we preach. We like assets. I think it's a great scenario for most practitioners to look at buying their practice premises. It gives you an investment asset, and it's going to be there for the long term. Why do so many people buy? Tal ran through a whole list of issues around that: security, longevity of premises, investment scenario. Is it an investment or a business decision? And that's something that we talk to our clients a lot. So it really depends whether that asset is an investment grade asset that you want to hold for the long term, because it might be your asset while you're practicing. It might be your business premises while you're practicing, but long term, if it's owned in a super fund, it's going to be your investment asset. So you want to make sure it's a good investment asset. It's not something that's not going to have capital growth and it's not going to have rent and, easy to use and produce income in the future. Thinking about the cost and risk of having to relocate, Tal spoke about that as well, in terms of if you buy that practice and it's in your super fund, that's your asset. So if you move the premises, it's a pretty significant impact. It's going to have not just the business impact, but investment and super impacts as well. Is the cost of rent the same as servicing the loan? That's those cash flows we ran through before. So it's really know your numbers. Make sure you come and have a chat if that's something that you want to help with. But, what are your LVRs? What's your cash flow commitments? How much super am I committed to in terms of future contributions to hold it? We have an article which is on our website, and certainly we can send it to you if you want to have a follow-up or more information about it. That's it. Any questions? Otherwise, we're here afterwards.
Thanks, Alison. I just realised I've only got 13 years till I get to my preservation age, so I've got a fair bit of work to do to be able to get my money into super. Thanks, Alison. Our next speaker is this evening is Brooke Glastonbury, a principal lawyer from Macpherson, Kelley. Brooke specialises in healthcare property and construction. She sees all sides of a deal and can quickly gauge what risks are worth considering, as well as what a vendor may push you back on. As an accredited property law specialist, Brooke is able to cover all aspects of property transactions, including advising business and asset owners on property and finance transactions, due diligence, negotiations, acquisition and divestments, property development, planning, leasing and conveyancing. Please welcome Brooke.
Good evening, everyone. I guess by the time I come into the picture when you guys are looking to buy or lease premises, I can say that a lot of clients are well and truly over the whole process. As Tal said, sometimes it could be 12 months, 18 months, 2 years that you've been looking for an asset. So by the time you come to me, the last thing you want me to tell you is be patient. It could take 6 weeks, it could take 8 weeks, it could take 12 weeks. The most important thing that you can take from tonight is that take the time and be patient, because you need to get this structure right. Wrong way. Okay, so most important thing is to speak to your lawyer, your accountant and your consultants. Make sure you've got the trusted advisors around you who understand the process of self-managed super funds. You can find accountants, lawyers and other consultants who say, yeah, I get it, I can help, I can understand it, and they fumble their way through and they think it's an easy thing to learn. Don't let you be the first person to enable those consultants to learn the structure, because it is very complicated and there are some dire consequences if you don't get it right. The most important part about speaking to your lawyer first is at a point in time when you're confident or you think you've got the asset, is to make sure that all your documentation is correct and that you know and you understand what processes you're going to have to go through. Sometimes it could be a matter of, it may be a couple of days to a week to get all the documentation prepared, but other times it could be a matter of weeks, particularly if you haven't got a self-managed super fund already set up, because it could mean you need to be able to pull that money from your managed funds into your self-managed superannuation, and that takes time.
Yes. Question: what happens if I buy a property in my super fund's name and I put all the wrong names on the contracts?
I'll be getting to that, because that's a pet hate of mine, and it's something that people just don't know. And at a point in time, whether you're at an auction or you're in a real estate agent's office, you don't know. The agents just want you to sign the contract. They don't care what the consequences are afterwards. So I'll go through that, and that's actually one of my examples and case studies. So understanding the costs involved in the acquisition and the ongoing management. So as Alison said, purchasing a property in your individual capacity or company or trust, the costs are a lot lower. Purchasing it in your self-managed superannuation fund from a legal cost perspective is always going to be much higher, because you've got so many different documents in the background that need to be prepared, particularly if you're borrowing money to acquire. Under the SIS Act, there's requirements around having different entities set up to hold the asset because a superannuation fund itself can't hold legal title to the asset while there's a borrowing arrangement in place. I'll go through that in a moment with you as well. But that's the process I'm saying. You need to have all of that correct and to understand what's going on, or if you don't understand it, to make sure that you've got everyone around you who does and they can guide you through that process. So for important to establish your super fund trust deed, and for existing super fund trusts that already sit there, to have the documentation reviewed. So if you set up your self-managed super fund many years ago, there's a lot of powers that are required under the SIS Act for the borrowing arrangements that may not exist in your trust deed. The important ones that I've highlighted here is the authority to operate a bank account, the ability to borrow, and the most important one is to actually appoint a custodian to hold the legal title to the property. So your solicitor would review those documents before you even get anywhere near signing a contract to make sure that your trust deed actually allows you to do that, because if it doesn't, we need to vary the trust deed to make sure that those powers are put in there, because those documents are going to be something that your bank solicitors are going to look at, and if you don't have the powers, you're not going to be able to borrow. The last thing you want to do is have a contract that's exchanged that you can't get out of, but also don't have the ability to get the funding from the bank because all your structuring documentation aren't up to scratch. As Tal said, due diligence on the property is incredibly important. You don't want to end up with an asset that you can't use for the purpose that you've bought it. But also the due diligence with the contract for sale is really, really important. By the time you've inspected the property, you've gone through your 9 months, 12 months, 18 months of looking at the property, deciding you're going to buy. This is obviously the buying scenario. The contract for sale, provide your solicitors with the background as to what you're using it for, okay? We review contracts for sale when people buy a property. We ask questions. Sometimes we get the answers around what the purpose of them buying the property is. But unless you specifically tell your solicitor that you're buying it for a medical practice or a dentistry or whatever it is, we'll advise you based on what's in the contract, rather than from the planning perspective and looking further into the LEPs, the DCPs, to see what can be done, what approvals do you need to actually use the asset for the purpose that you're buying it. And at this stage, if you haven't already spoken with your accountant and set all your structure up and had the advice from your lawyers around the super fund trust deed and what you need to do, this is the time where you actually need to make sure all the entities, or the entity that is actually going to hold the legal title to the property, should be set up. Don't leave it to the last minute, because generally there's a mad rush, or I get a call on a Friday night saying, we're here with the contract in front of us, can I sign? What name do I put on the contract? And I say, well, have you set up this company to hold the legal title to the property? Oh, no, we were going to do that next week. Well, sorry, you can't sign the contract because the name on the contract is the most important aspect of that contract. Okay, so this is, I've limited this to what I think will make it easier to understand. There's a few more bits and pieces to this whole diagram here, but for you to understand, and if you keep nothing else from the slides from tonight, so I highly suggest you keep this, because this will set, when you speak with your lawyers and your accountants, they will say custodian, vendor, LRBA, where does everyone fit in? So this is where they fit in. So you find your property and you're dealing with your vendor. And then you've got this custodian trustee. So the custodian entity is the entity that I said will hold legal title to the property. They are not the trustee of the super fund, and it's a company that will do absolutely nothing else other than hold the legal title to the property. So it's a company where generally we mirror the directorship and shareholding of the custodian entity to that of the trustee of the super fund. There's no requirements for that, but most lenders prefer that. So that custodian entity will be the name that goes on the front page of the contract. So if it's ABC Proprietary Limited is that company. That is what goes on the front page of the contract. You don't reference the superannuation fund. You don't reference the trustee of the super fund. It is just that company. That company, at the time you enter into the contract for sale, will also have an agreement with your superannuation fund. So the trustee of your super fund will enter into a document with that custodian entity where the trustee of the superannuation fund says, I've found this asset, I want you to buy it and I want you to hold the legal title to it. You'll do nothing else other than when I tell you to do something. If I want you to transfer the title back to me because the superannuation fund is the beneficial owner of the property, that company has to do that. The company does not do anything with that property unless the trustee of the superannuation fund tells it to do so. So in this scenario, because there's a borrowing arrangement in place, obviously the bank will only lend money if they have security over the property. So the superannuation fund will borrow money from the bank under a limited recourse borrowing arrangement. The superannuation fund will be the borrower. The custodian, because it's going to hold legal title to the property, the only way that they can be brought into this borrowing arrangement is if they provide a guarantee. So similar to you, if you're buying a property, you need your parents to go guarantors for the loan, or put another property up as security, there'll be a guarantor in place to connect everyone to the relevant securities. So the custodian will be a guarantor to the bank, and there'll be a loan agreement between the bank and the superannuation fund. As Alison said before, the reason we have to have this custodian there is so that the bank can only ever have access to the property that it is lending the money to enable you to purchase it. So if you buy one property today and in 6 months' time you buy another property in your superannuation fund, you'll be setting up another structure of this kind. Some banks are okay with using the custodian entity under each bare trust arrangement. Most banks don't. So they'll have a requirement. Each time you have an asset, you set up a custodian entity and you have a new bare trust arrangement between that custodian and the superannuation fund relating to that particular property. Yes?
Excuse me, between the custodian and the bare trust, are those two terms used interchangeably or are there any differences between the two?
They're used interchangeably. So the bare trust is a bare like a trustee to family, a unit trust essentially, but custodian and bare trustee are used interchangeably. I always refer to it as custodian, but I know a lot of people refer to it as bare trustee, so I've put both of them in there for you. Okay. The other thing is that some lawyers actually name the bare trust, so that the contract between the superannuation fund and the custodian, some lawyers give it a name. There's no need for a name because it is simply a contract between two entities saying, I'm the beneficial owner and I want you to hold this and buy this property for me. But either way, it's okay.
Can trustee be guarantor?
Can the custodian, trustee?
Yeah, trustee.
Yeah, so
guarantor?
this entity will be the guarantor. The super fund, with the trustee of the super fund, will be the borrower. Okay.
But the regulations in trustee cannot be guarantor.
So it's not the trustee of the superannuation fund, it's a separate entity. So if you've got ABC Proprietary Limited, who is your trustee of your super fund, that entity is sitting here. You have to have a completely separate entity who is holding the asset, and that entity will be the guarantor.
But practically, trustee is a member of the SMSF.
No. So your individuals are members of your super fund. The trustee is the entity that does everything for your superannuation fund, because your superannuation funds are not a legal entity. The trustee of the superannuation fund is what does everything for the superannuation fund, but this separate entity will purely just hold the legal title to the property. Does that make sense?
Because usually trustee become director of
No, so the directors of the fund are the members of the fund, not the trustee. So the directors of the trustee will be the members of the fund.
Usually trustee is a member.
No. So the trustee, we usually use a...
I mean for self-managed.
Yeah, so sometimes you can have, with a self-managed super fund itself, you can have individual trustees or you could have a corporate, a company trustee for the actual super fund. When it comes to the Bear Trust / custodian, the banks will always want you to have a company as the trustee of the Bear Trust.
And the banks will also, I mean, you can have a superannuation fund where you are the trustee of your superannuation fund and you're a member. But as soon as you come to this situation where you're borrowing, the banks will require you to appoint a new trustee of your superannuation fund and actually require you to appoint a corporate entity. It's not a requirement, but the banks don't like individuals being trustees of the super fund when there's borrowing arrangements in place.
And the same company can't do both roles.
Correct.
You have to have one company as the super fund trustee
It's two
and
separate
a separate company
Correct.
as the Bear Trust
In
trustee.
reality, practically, this is for self-managed, for family.
Yes.
So family become both. Trustee.
Yes, yeah, the directors and shareholders are all the
Same, yep,
but two
Different.
company names.
Yep.
Understand. Yeah,
Yep.
thank you.
okay.
Just as a side question,
Yep.
I think it's just for Alison probably. Do you have to prepare bases for all these companies?
No.
Or is it just
Only everything from a tax perspective is all covered under the super fund accounts and tax
Right.
returns.
And that includes also registration for GST. It's all done in the superannuation fund.
Alright, that's a good.
Yeah. So literally that company sits there and holds the legal title and that's it. Okay. As I said, so entering into a contract before you've got the structure set up can be disastrous. There's no room for buy now and think later. The outcomes of that, and I'll go through some examples, is the worst outcome that you could see is that you've got to pay double stamp duty on a property. Okay, where you've got a contract for sale that you can't get the borrowing because it's wrong, and you can't rescind it if the vendor doesn't agree to rescind and enter into a new contract. You're going to have to transfer it to the correct entity, in which case you're going to be paying stamp duty on both transfers. So that's why I say it's so important to get it right, because no one wants to pay stamp duty the first time, let alone having to pay it the second time when it could have been helped. And one of my case studies will be about the contract for sale having the wrong entity on the front page, which is what Heath asked the question about before. Okay, so the first example. John enters into a contract for sale for the purchase of business premises. He's going to use it as medical practice. The purchaser on the contract was ABC Property Holdings Proprietary Limited as trustee for the ABC Superannuation Fund. But John needs to borrow money to buy this asset. So going through what I just said before, if there is any borrowing arrangements, there is no reference to the superannuation fund or the trustee of the super fund on the front page of the contract. It has to be that custodian entity, and that is it. So the Superannuation Industry Act provides that where a super fund's permitted to borrow, but it has to be held on trust for the super fund. So that's where that custodian entity requirement comes in. As soon as the debt is paid out, the property can be transferred back into the trustee of the superannuation fund with no stamp duty or nominal $50 stamp duty. But whilst there is debt there against the property, it has to be held by the custodian entity.
Can I just second that?
Yep.
Mean, we obviously deal in a lot of transactions of self-managed superannuation fund nature, and it astounds me the number of solicitors that are out there that do not know the answer to what goes on the front of a contract. So if you are going down this path, please seek the advice of someone that knows what they're doing, because the consequences, as sort of described in there, can be very, very expensive.
Yeah, and just on that note too, Tal, that when any property is bought, when there's a trust sitting behind it, no trust should ever be put on the front page of a contract. It should only ever be a trustee, the corporate or the trustees of the trust. The reason for that is that there's been quite a lot of case law and Revenue New South Wales may, if they pick it up, assess that contract for sale as a separate declaration of trust, and there'll be additional stamp duty on that creation of that trust. So if you have a solicitor or an accountant who tells you to put the reference to a trust on the front page of the contract, think seriously about getting a second opinion, because it should not be there. The way that we get around making sure that if a trustee of a trust or a trustee of a super fund is acquiring an asset, and if you want to see that someone knows that it is actually the superannuation fund or the trust that's buying that property, put a special condition in the contract. We put a limitation of liability clause in every contract where there's a trust or the super fund to say the purchaser on the front page of the contract is acting in its capacity as trustee of this trust or of this superannuation fund. That's enough. Your accountants, everyone else who does all your financials, record the asset being held in the correct entity, but there is no need to have it. There is definitely no need, and you should not have it on the front page of a contract for sale.
It's interesting, Brooke, though. I've seen it for Queensland, though. It's different.
Queensland's very different. Yes, very good pick up there. Yeah. So this is New South Wales only.
Then when I'm getting stuff organised, like the operations team will come back saying, "Oh, where's the trust name?"
Yeah.
So wait a sec, it's New South Wales.
Correct.
It's not Queensland.
Yeah.
So each state is different.
New South Wales and Victoria have very different requirements regarding stamp duty, and also the ability to nominate different purchases and different entities and changing contracts between exchange and settlement. So this relates specifically to New South Wales. If you're looking to buy in a different state, find a solicitor in that state who understands all of those requirements.
Further to, I guess, what Luke was saying is that, sometimes there's a perception that if you put and/or nominees on the front of a contract that you can change it, and
Yeah.
I think in Victoria that is the case.
Correct.
You can do that.
Correct.
But over here it's
Yeah, in New South Wales, a definite no-no. Probably I'd say about 20 years ago, it was a common thing to do in New South Wales. But then obviously updates with the Duties Act, then it was pulled in as though that would be deemed a transfer. So, I mean, I don't know if many of you have listened to or know about how developers usually buy land. So they don't normally enter into a straightforward contract. They'd enter into an option or some kind of option arrangement, which would enable them to carry out some due diligence on the property. And they sometimes have the ability to nominate or sell their option on. Even that's a very similar situation to having an and/or nominee. So the party who enters into the contract at the time may not have the intention of being the actual ultimate purchaser. They might want to nominate someone else. But in New South Wales, unless you're related parties at the date of entering into that contract, there'll be double stamp duty. Okay, I digress. So as I said, because the wrong entity is on the front page of the contract, the issues here will be that if you can't fix the contract or rescind the contract and enter into the contract with the correct entity, you're going to be in a situation where you can't get funding, and you'll end up either having to transfer it to the correct structure, in which case you'll be paying stamp duty twice, or defaulting under the contract and losing 10% deposit plus damages and costs that the vendor may be able to sue you for. What we've seen in this situation, particularly probably a number of years ago, when the whole buying property and superannuation funds with these LRBA arrangements with the banks came into place, a lot of people were getting it wrong. So we had situations where vendors were being very accommodating once it was identified that we need to change the entity on the front page of the contract. But in doing that, to have a vendor agree to fix anything, it's going to cost money. Legal fees for a new contract, deed of rescission, stamp duty refund, whatever it is. So it's not a position that you want to be in when you can really get it right the first time. And if it's going to take you an extra day or two to get to a point of an exchanged contract at the beginning, saving you all the headache at the end, being patient is definitely worth it. Okay, another important aspect to understand from the superannuation fund perspective is if you're buying the property in your super fund, all the money must come from your super fund or through the borrowing arrangements, okay? You can't put any money in from your own bank account when you're sitting there in the real estate agent's office signing the contract, it's all got to come from the superannuation fund or the borrowing arrangements. One thing at the end of the transaction, which people do forget to do, is stamp the bare trust deed, the custodian bare trust deed. So going back to that diagram that I had before, the bare trust deed was between the custodian and the superannuation fund. That is like a trust document that needs to be submitted to Revenue New South Wales to be stamped, because in 10 years or 15 years' time, when you pay the debt off, you're going to need to use that document to be able to get the property transferred back to the name of the superannuation fund. If that step has not been done, you'll never be able to transfer the property back. You'll have to pay stamp duty, or it's going to have to stay in the custodian entity's name. Okay. I'll do one quick more example, and then I'll let Luke have a go because I know that we're running out of time, sorry. This just goes back to the paying the deposit from personal funds and not your super funds. So sitting in the agent's office, client exchanges a contract, they've got to pay 10% deposit. John sits there on his phone, transfers 10% deposit to the agent. Agent says, yeah, that's all good, no worries, you can sort that out later. It's not good at all, because if you've paid money from your personal account when you're entering into a contract with a super fund as the beneficial purchaser, the money's not come from the super fund. How do you get the money out? It can either be seen as contribution to your super fund, or what I've suggested in the past, where, because this has happened on a regular occurrence with clients, pay the money to the agent from your super fund and ask the agent to refund the deposit back to your personal account to reverse that transaction. Because when you go to the situation where you've got to send all the documents to Revenue New South Wales to be stamped, you've got to prove to them, you've got to provide them copies of bank statements, loan documents to show that the super fund has provided all the funds, whether through existing cash resources or the loan arrangements. I think that's just what I went through. There you go, Luke. Sorry to cut everything short, but Luke, I know we're running out of time. We'll all be around here later, so please feel free to come and ask any questions.
Thanks, Brooke. So my name is Luke Truscott. Been with BOQ Specialist now for, has it been 10 years now? So I've been working with practitioners. It's been close to about 25 years now, just banking and finance for practitioners. I only work in the commercial and business space, and one of the main things I do is self-managed super fund lending. So we'll go through some stuff tonight, and hopefully I can keep you all awake. I'm the last speaker for the night, so after this you'll have a well-deserved drink and something else to eat as well. As already mentioned, so the only security that we take is the actual property. We don't take any other property as security for the loan for the super fund, right? Key thing to be able to be aware of is what can be used to go towards paying the monthly loan repayment. So obviously the self-managed super fund is the one that's taking out the loan. It's the one that's got to pay the monthly loan repayments, right? So obviously if your practice entity is renting the property off your self-managed super fund, so you may be a sole trader, you may run as a company or trust or whatever, and you're renting the property off the super fund, obviously you're going to pay rent to your self-managed super fund, and the self-managed super fund is going to use that money to pay its monthly repayment. But the self-managed super fund can also use other income that it gets to be able to pay off the loan, right? So if you've got other investments, in the self-managed super fund, it's earning income from shares, dividends, and all that sort of thing. You can use that to pay off the loan as well. Okay, so it's not just limited to the rental income. Now, the thing is, with us BOQ Specialists, we're lending like up to 90% in super, right? So for us, and there are some other financiers out there that do it. A common one in super, when you're buying commercial properties, they'll lend a maximum of 70%. Now, because obviously we only deal with doctors, dentists, vets, healthcare practitioners, lower risk, so we'll be happy to lend up to 90%. But we will take our practitioner's guarantee. So we'll take the practitioner and the other member, which is usually the spouse. We'll take their guarantee, personal guarantee. So obviously the borrower is a self-managed super fund. We've got that bare trust, asset trust, custodian trust as a guarantor. We'll also take yourselves guarantees as well. Okay, all right. At the end of the day, I suppose, I haven't seen it happen from a legal perspective as to what's happened. if the self-managed super fund can't repay the debt. But at the end of the day, the individual can also put in a non-concessional contribution into super as well if it really needs to be able to pay back the debt, the monthly repayment, right? So obviously you've got your concessional contribution of what, $27,500 a year that each of you are putting into the self-managed super fund. You've got rent going in there as well. But let's say for some reason it was short, yourself as a guarantor, you can put extra money into super as a non-concessional contribution, which Alison said was like up to $110,000 a year, okay? So what we do is when we're looking at the loan itself and seeing whether or not we're going to approve the loan, we actually have to make sure that the self-managed super fund can service the debt. So as mentioned before by Alison, we need to look at the $27,500 each year as the concessional contributions that the members are putting in to super. Let's say it was industry super initially, now it's going to go into the self-managed super fund. You have to see what sort of rent is going into it as well. So we need to make sure that the self-managed super fund can actually service it. But we're also doing an assessment outside of super as well. So I also want to be able to have a look at the guarantors as well, and also let's say the practice entity too, to see how that services its own debts, home loan debt, might be paying a lease on equipment finance and all that sort of thing. I need to make sure that that entity outside of super can service all of its debt, and also see what money is left over outside of super. So again, if there's a situation where the self-managed super fund can't pay the debt, we know that outside of super, they've got enough money to prop that up, okay? Another thing that's important, obviously, that with commercial property, you can actually obviously rent to a related party. So obviously you're as the practice entity, sole trade or whatever, obviously you can rent the practice, you can rent the property off the self-managed super fund. Also, it can be an unrelated party. So if you go and buy, let's say, premises of a coffee shop, whatever, you can rent that out to someone. That's fine. That's no problem. If you want to buy a residential investment property in super, it has to be definitely an unrelated party. You can't go and rent the property off your self-managed super fund, okay? Key things about the loan, they're very basic loans. There's no bells and whistles. There's no, for us, I've only really come across maybe one lender who doesn't lend on self-managed super fund anymore that had an offset account, right? But for us, the financiers that I've seen, a couple out there that do it, like let's say Liberty and stuff, they don't have offset accounts, all these sort of things. It's just basic, principal and interest, variable or fixed rates, those sort of things. There's no all of these extra things like you'd get with a normal home loan. When determining the interest rate, which was mentioned before about rates being a bit higher in super, okay, and that's obviously because we only have the one asset as security. We only have the property as security. So therefore, there's a risk reward thing playing there. Funding costs are going to be higher when you don't have as much security, I suppose, and also lending a higher amount as well. So, if you're borrowing 90%, let's say the property is $1 million, you're borrowing $900,000 in super, that rate is going to be higher than borrowing $700,000 in super or borrowing $500,000 in super. So the interest costs are going to drop when you don't have to borrow as much in super, okay? Because again, the risk is reducing. If something happens and we need to offload that property, let's say you borrowed 90%, $900,000, we've got to offload that property because you can't pay back the debt. We've got a risk of losing because we might have to offload that property quickly. We're not going to be able to get the same price for it. So there's a good chance that we might lose some money. While if you'd only borrowed 70%, we're going to be in a better state where if we had to sell it, for $900,000, we haven't lost, okay? We also look at the risk profile of the client as well, right? You've got to be careful in regards to the contributions. If the contributions, the concessional contributions that you can make to super, which is $27,500 at the moment, we've also got to factor in a bit of fat at the end when we're doing the servicing on whether the super fund can afford the loan. We need to see that there's enough money left over that also if there's any concessional changes, rules change and that, the super fund's still going to have enough money coming in to pay the monthly loan repayments. I've mentioned already we can do up to 90% for our clients. you've got to be careful about paying down the loan too quickly. So if you've got a $900,000 loan and you dump $100,000 in there into the loan, you can't go and redraw that back like you would on a home loan. That is not allowed whatsoever. Okay, and also once the super fund has paid off the debt and there's no more money left owing on the property, that's it, done and dusted. You cannot use that property again as collateral or as security in super to buy another asset. Okay, so very different outside of super. You've got a home in your personal name, you pay off the debt, you can use that property to gear up and buy another property and borrow against the property that you already have. But in super, you can't. You've paid off the loan, it's fully paid off, that's it, done and dusted. You cannot use that property again as security for another loan. You have to come up with the deposit, the stamp duty and the miscellaneous costs and everything inside super again to cover the new property that you want to buy. Okay. So that's why you've got to be very careful as to how much money you dump into that loan, because your strategy in the super fund might be to buy another property. And if you've already dumped that money in, then you've lost your deposit potentially for the other property that you want to buy.
Excuse me, is the reason that if you were to purchase a property and want to make additional contributions to the loan, is the reason you're not able to redraw those funds due to SMSF legislation?
Yeah, I think it is. At the end of the day, it comes under the SISTAC, I believe. Yeah. I don't know what.
You can only borrow to acquire the asset or to refinance the original debt to purchase the property. You can't use it, as Luke said, as collateral to other loans, and you can't just decide to borrow because I want to be able to use the money for something else or for improvements on another property.
Yeah. Yeah, you can't borrow to improve the property. The other thing as well is what you'll find when you want to borrow in super, there can be some conditions, right? So for example, I have a practitioner who wants to buy a property in super and it's for their practice. Okay, generally I need them to have 400,000 net asset position in their self-managed super fund, right? We do have a condition where the client can have 200,000 in their self-managed super fund, but they have to be of 40 years of age or less. Okay, so if you've got 200,000 outside of a self-managed super fund in an industry fund, where most of our clients have their super fund money, it's all sitting in an industry fund. If you've got 200,000, you're 40 years of age or less, right? You want to be able to purchase your practice premises, because you've got to think as well, if I'm only buying a property that's $1 million, okay, I'm going to be able to borrow 90%. So let's say that means a $100,000 deposit I'm going to have to make, plus stamp duty and miscellaneous costs and so forth, which might be, let's say, 50,000. Then, the self-managed super fund, when you move the money from industry super into the self-managed super fund, it's now got 200,000. It's going to have 50,000 left over after it's paid those costs, okay? But obviously you're going to be restricted on the purchase price as well. Okay, but if I have a client who wants to buy a residential investment property, you've got to have 800,000 net assets in your self-managed super fund. It's different, right? And most of the financiers I've seen out there want 800,000 net asset position, whatever you're doing. Right? But with us, we'll drop the requirement. And the reason for that, obviously, is our clients are low risk, right? So we'll take on that risk, okay?
Can one borrow more than one loan?
Can you have more than one loan in the super fund for that property? Yes. So you
Not different property.
for different properties, yes. Yeah. So you could have a property for this location, a loan for that location, another loan for another location. Obviously, you're going to have another bare trust, right? So you've got to create another bare trust. But
As long as we meet the conditions.
as long as it can service it as well, yeah. So it has to service it. Like one of my clients have got between them now, cardiologist and his brother. There's the two wives and the two brothers. I mean, they've got 15 properties in their self-managed super fund, 15 commercial properties in their self-managed super fund. So again, you can have multiple different types of super fund members. I've got one client where it's the father and the daughter, another one where you've got a situation where it's brothers and the wives, and other ones where it's the practitioners. So you can have all different types. This one here, I just wanted to show you a quick case study. So this is a common one. So I had one of my clients who wanted to be able to purchase a commercial suite. You got retail down the bottom. You got residential upstairs. Purchase price was $735,000. Valuation came back at 700. Doesn't happen that often, but I just wanted to be able to show you the different examples of when the valuation does come in a bit less. Okay, so this client wanted to be able to borrow 90%. So purchase price 735, right? And the value came back at 700. So obviously I'm only lending 630,000, which is 90% of 700. So that means he had to put in the rest. He had to put in a $105,000 deposit. Okay. The rent was $45,000 per annum. So I'll show you the deposit. Also, a thing that's important is GST was applicable on this one. So when you buy premises, right, whether it be inside super or outside super, when you buy commercial premises and there's no tenant in there, it's vacant, GST will apply. If there is a tenant and a tenancy lease is in place, GST won't apply. Okay, so in this instance, $73,500 was another cost that the self-managed super fund had to pay, right? So these are things you've got to be careful of as well. That's why I've got to make sure you got enough money in super to make sure you got enough to be able to cover all the upfront costs as well. You've got all the sort of normal fees that you would have with buying a property. Obviously, I've got there the GST, the stamp duty. The stamp duty applies not only on the purchase price, but also the GST as well, okay? There's costs setting up the asset trust, custodian trust, bear trust, right? All the same name, all the same thing, I should say. The corporate trustee, solicitor costs, obviously I've got this one here that I looked at for this particular client, right? But then you pay what you get as well. So I had many instances where things aren't getting done right, and I've actually got to tell the solicitor what's got to happen, but still tell them that they've got to take out their own legal search on all the stuff to make sure. So I've usually told the client be very careful of the solicitor that you're getting, because a lot that I've come across in the past haven't done super fund lending before.
What should be the implication for GST if you make an arrangement whereby you lease first and then to transition to a purchase later?
That's right, yeah. So definitely, so I've seen situations like that before where the practice entity has rented the property and then they've purchased the premises and GST hasn't been applicable. So in this instance here, the cost was like $221,000. The other thing I just want to add to this, that's why you got to make sure you've got the right advisors. I had one client, and this is why I always tell every other client. So one client, their self-managed super fund was supposedly set up by a super fund advisor, because that's what they specialised in, but I don't understand why. But when the BAS was set up, when the GST, like the BAS was set up for the super fund, it was set up as an annual BAS to be done, right? So what happened is the clients went and bought the property, but then they had to wait over a year to be able to get the GST back. So yes, you have to be very careful. So most clients do a quarterly BAS, or I should say the super fund does a quarterly BAS, so at least it can get the money back. The other thing I do for clients, which I haven't got in this scenario, is that I'll also do a loan for the GST too. So I'll have one loan, again, doing it because low risk clients. So I'll do the 90% loan, let's say, or whatever the amount is. And then I'll also do a loan for the GST too. And that'll be I'll make it a 6-month interest only loan, because then that's enough time for the super fund to be able to get the GST back. And then it can pay off that loan, and then that's cleared, and then all it's got is the loan on the property. Just wanted to show an example here where I've got their term of 5 years. That was supposed to be 30 years actually. So in the old days, we used to do it where we wanted clients to be able to pay off a certain amount of the property in a 5-year term, but now we've changed it where clients can actually pay off the self-managed super fund loan. We've actually extended it up to 30 years. Okay, so if you borrow 90%, the super fund's got 30 years to pay off the loan. But let's say you're 60 years of age, I won't be setting up a 30-year term, okay? I might be setting up a 5-year term with a repayment profile of a 30-year term, but I won't be setting up a 30-year term, okay? Because the thing is, you're not necessarily going to be working at 90 years of age, right? As we said, what I had with this one is the rent, obviously, that was being paid to the self-managed super fund. That was $45,000 per annum. The self-managed super fund contribution from the two members, $27,500 each, so $55,000 per annum. So if I just keep it to the rent and the contributions, $100,000 is going into the self-managed super fund as income. There might be share dividends and stuff like that, but if I just keep it at this, $100,000. The annual loan repayments was $50,000. So if I actually work that back and go, okay, let's say we want to use that whole $100,000 to be able to pay off the self-managed super fund loan, it's going to be paid off in about 8 years, right? So the reason for this, of me putting this example together, is because I usually have a lot of my clients pay off their self-managed super fund loan quite quickly. So even though it might be set up as a 30-year term or 25-year term, I'm generally finding that it's getting paid off quickly. And obviously, a factor of that is you've got, there's the less rate of tax for the self-managed super fund paying of 15%. They've got their rent going in there as well. So I usually find that they're able to pay it off a lot quicker. Usually a lot quicker than paying off their home loan. The other one, and then also this slide is basically to be able to show you the practice entity, because this person bought a vacant property. It was empty. There was concrete on the floor. There was no partitioning, no plumbing, nothing like that. Of course, they had to fit it out, equip it out. So we then gave the practice entity a facility to be able to then pay for all that fit out and equipment as well, okay, as the tenant, okay. The other one I wanted to show you is one where if you wanted to buy, let's say, land, then construct premises as well. So let's say you bought a block of land. In this scenario here, it was out west, very west country of New South Wales, so very cheap at that time. Back in the day, I think it was quite a few years ago, and they only paid $205,000 for the land. So there was an old building on it that had to get knocked down. I gave them a loan of 80%. Now, technically, I can give higher loans outside of super. So let's say you as a sole trader wanted to be able to buy commercial premises. Yeah, sure, I can give you 100%. At this stage, it was speculative because, yes, sure, their intention was to have it as a practice, but I had no due diligence. I didn't know how much it was going to cost. I had no idea, And so we said, okay, what we'll do is lend you 80%, because that's what we'd normally do for a commercial investment outside of super. So they put 20% deposit in. They bought it in their personal names, let's say Joe and Jane, right? Because we always knew that once the construction was done, we were going to then move it into super later on, okay? So, and then during that term, under their personal names, I was only getting them to pay interest-only repayments until the construction had finished, because it actually did take quite some time before they got DA approval, all that sort of stuff. But they had done their due diligence up front and spoken to council to be able to confirm that they were going to be able to have that as their practice premises in the future. But again, I didn't go doing all the checking and all that sort of stuff, because I said to them at the end of the day, you're buying this now, you haven't got council approval yet, that's why I'm only going to give you 80% and not the 100%. And they were fine with that. Obviously, it was a cheaper property. It was only $205,000, very different if you're buying a block of land here in Sydney. And then what we did was I provided them construction loan of $975,000. I did take $100,000 cash security because there is construction risk as well. So with this example, I was giving them 100% of construction costs. They'd borrowed 80% on the property, the land. I was giving them 100% of construction costs. It was a brand new practice. It was a country area, but obviously she had a VMO position at the hospital. She had been working in a GP practice and so forth. So she was well known in the community. So obviously the risk was low, but still, I didn't know if she was going to be successful at all with a brand new practice. I really didn't. So we still took some security. We still took some cash as security because there's construction risk. And so, we paid the builder and everything. We also had to provide another $350,000 on top to the practice entity, which was in her company, to be able to do all the fit out, internal fit out, the reception desk, the signage and all that, because the landlord, which was them personally in their personal names, they weren't providing the reception desks and the plumbing for each of the consult rooms and surgery desks and all that sort of stuff. That had to be funded by the tenant. So, and look, it was all done by the same builder, but we split it out. We split it out that the practice entity would pay for all this fit out, and then obviously the landlord, being the individuals at the moment, let's say Joe and Jane, they took out the loan for the construction. And I think I had there, just going back. So yeah, what we did was, so the total costs for the individuals as landlords was that $164,000 80% loan on the land, plus the $1 million as the 975 construction costs. Valuation, that's the thing, valuation didn't come in at the total amount of what they spent. The valuation at the end only came in at $1 million. Okay, so there was that gap. But we got that valuation because that was actually going to be the purchase price to sell it to the super fund at the end. So now before it was sold to the self-managed super fund, there was a tenancy lease put in place between the tenant, which was the company, the GP's company, and the landlord, which was Joe and Jane. Okay, so the lease was already in place, so that when the super fund bought the property off Joe and Jane, there was no GST, okay, because there was a tenancy lease in place. And also, which Alison mentioned before, the self-managed super fund didn't have to pay any stamp duty except, what was it, $500 in this scenario. So they didn't have to go and pay stamp duty again. Now, in this situation, they actually had quite a fair bit of cash in super as well. And that was the other thing, if I think back as to, well, why did we still do the loan for them, and it was 100% as well, and she'd never had a practice before. But also, I saw how much of a balance they had in their super fund too. This was the end position of what we were going to do. So the beginning debt was quite high. You know, we're doing over 100% on the value of the property. But at the end of the day, the super fund had about 500,000 in it. And the end position that the loan that we were going to do was only going to be 500,000 at the end, right? So there's a few stages till we get to the end. And this did go over quite a number of years. But the end game is that the super fund took out a loan for 500. And obviously, you know, the GP and the spouse, they received $1 million from the super fund. They used that to pay off the debt with us. They had to add to it an extra $139,000 because remember the costs of the construction, that was higher for them. And then at the end, it was all done. There was no construction risk that came in within budget. So the $100,000 went back to them as security, the security that we held. So I just wanted to make sure I showed that example because that's been a common one that I've done for clients over the years too. But also you've got to be careful too how it's done. I had GP clients that I helped down in Tassie. That was a different scenario. They actually purchased, when they still purchased the property and they owned it in their personal names. And this is why you've got to make sure you've got advisors around you, because they ended up claiming the GST when they were doing the construction. They were claiming the GST on the builder's invoices. So and they had created a partnership entity between the two of them, so that when it was actually sold to super, the super fund actually had to pay stamp duty in that scenario. And that's why I always say, this is a scenario that I've done many times. This is another scenario that I've seen. That's why you need to make sure it's all structured correctly before the transactions get done, okay? And we've mentioned before a couple of other different structures, which is obviously practitioners forming a super fund themselves. I personally, I don't know what the actual repercussions are if something ever happens, and that would be a great question for Brooke if there was a falling out between the partners. So if you've got a super fund between a couple of practitioners, they're only related through working together. If there's a falling out, what actually happens there? So that would be a question that I would want to ask the solicitor if I ever did that structure. Another structure that I do quite often as well is where you'll have a unit trust be the purchaser of a property, right? And what will happen is the practitioners will all buy shares, buy units in that unit trust through their super fund. So they'll get their self-managed super fund to buy the units in the unit trust, and therefore their self-managed super fund becomes unit holders of that unit trust. So I'll do it where I'll end up lending the money to the unit trust. I'm not lending money to the self-managed super funds. So I'm lending it to the unit trust, and I'm taking the practitioner's guarantees. The money has been dumped into the unit trust through the self-managed super fund buying units in the unit trust. And that's what they'll use the money to then, if they want to, pay for the deposit, stamp duty, miscellaneous costs, those sort of things. So there are different ways of doing it in super, and that's why it's going to be very different for each person too, depending on each person's circumstances as well.
That second structure has an impact on interest rates and LVRs in terms of borrowing.
Well, it's different. Like it's at the end of the day, like we'll treat it very differently. So we treat it as if it was like a sole trader buying the property. So it's actually a property being purchased outside of super. So technically, I can do 100%. I can lend 100% to the unit trust.
And the rate's lower?
Yeah. Oh yeah, definitely. When you're buying commercial property outside of super, yes, it is less, but then obviously tax is all different as well outside of super.
So, in terms of that last scenario, would the benefit obviously be the lower LVR and the lower rate, but then the benefit of doing it right from the SMSF would be the tax?
No, with that one where there's a unit trust and then you've got the unit holders being the self-managed super funds, the reason why they did that obviously is because each of them wanted to use their self-managed super fund money. In this situation, they didn't want to create their own self-managed super fund with them being members. And I think also another factor was, from what I hear from clients and then through their accountants and stuff, is that obviously when they go to retire, they can sell their units to another member who wants to come in and join the practice. That's another thing as well. So I've seen that. And also, I've also had situations where out of those unit holders, they're not always the self-managed super fund. I've had ones where a couple have been the self-managed super fund as unit holders, and a couple of them have been their family trust. So one of the practitioners wanted to do it in their family trust to be the purchase of the units in the unit trust. They didn't want to use their self-managed super fund. So yeah, there can be different reasons for it, yeah.
The scenario that you gave, the GP and the spouse and all that, was the reason you did it that way because they didn't have a self-managed super fund to start with?
No, the reason is because the self-managed super fund's not allowed to do the development of the project. So when you buy a property in super, it has to be a completed asset. Yeah. So, if in that very first case where it was buying a commercial suite, that's fine. The super fund was able to borrow money to buy that commercial suite because it's a completed asset. Yeah, sure, the tenant, which was the practitioner, had to take out a loan to be able to do the fit out and everything in there, but it was a completed asset. Here in the second one, the property, there was no dwelling, nothing. That's why they had to do it outside of super first. Yeah. And again, in that scenario, there was another contract of sale done. So, when they first bought the land, there was a contract of sale. They sold it to their super fund, another contract of sale. Yeah.
Which means it can fund, borrow, fit out as well?
Yes. So under that scenario, again, the practitioner under their company, they actually took out the loan to do the fit out, internal fit out. So it's for me, and obviously with the builder, we're trying to make sure that we get two separate tax invoices as well, right? So a tax invoice for all the construction work that's got to go to them as individuals, as the owner of the property, and then making sure we get tax invoices from the builder made out to the practice entity, making sure it's all split properly as well. Because when I was financing the fit out, I wasn't taking the property as security. I'm not allowed to take the property as security. I'm not allowed to lend money to the company, the practice entity, and then take security of the property because that's owned by the super fund or the bare trust. I only took security of the fit out itself. Okay.
But you don't treat it as a development.
Sorry?
You don't treat the fit out as a development.
more the whole bricks and mortar piece is more the construction stuff. Yeah. That was pretty much it, everyone. So if anyone's got any more questions for us, we'll be here. Like if anyone wants to have a drink or two, there'll be more drinks out there for you as well and something to eat. So thank you very much for coming this evening. I hope it's been informative. Hope you take away a couple of things from this evening that you've remembered. Obviously, if you ever want to get in touch with any of us individually, feel free to do so. And thank you very much for coming. Thank you.